The way money works is about to be dramatically altered. We may even be on the cusp of a technology revolution, one that will rival the internet. It's about two technologies, one called cryptocurrency and the other called the blockchain, and they are taking the world by storm. Startups, big companies, and even governments are investing in them heavily, and they're getting frequent mention in the news. Don't feel bad if you don't know what they are. They can be hard to understand, and fairly obscure if you're non-technical. But that's no reason to be left in the dark. In today's episode, I'm going to break it all down in simple terms. Cryptocurrencies, also called digital currencies, exist in many forms but work basically the same. For the sake of example, I'm going to use Bitcoin, which is the oldest and most popular. Bitcoin was introduced in 2009 as an open source software project. It has no owner or central authority. It is a community of users, all of whom can examine the source code or propose modifications. Bitcoin was designed as a way to put the control of money into the hands of users instead of in the hands of powerful entities, such as banks and governments. In some ways, this was fueled by the financial crisis of 2008, when banks in the US had to be bailed out by the government to prevent a collapse of the economy. That revealed how much of our financial system relies on trust in banks and what can happen if they misuse that power. Many also blame the government for its role in the crisis, especially the Federal Reserve, for policies that rewarded risky behavior. The premise behind Bitcoin is to create a payment system that puts neither control nor influence in the hands of powerful entities, and that works even in the complete absence of trust. It does that in an ingenious way that allows direct transactions, but enforces transparency in the ability for anyone to audit a transaction. This is in contrast to our current system, which relies on trusted intermediaries. Right now, if one person wants to make a payment to another, they have to go to a bank to transfer the funds, or use a third-party service such as PayPal. At the heart of this system is the concept of a ledger. A ledger is a record of transfers of ownership and is the basis of all financial transactions. Keeping the ledger honest is the key thing. What we do now is trust banks and third parties to keep the ledger honest. We need them to not make phony transactions. We want them to confirm that every transaction is legitimate, and we hope that nobody hacks their ledger and steals our money. Unfortunately, this is somewhat wishful thinking. Banks have been caught in scandals over the years, and although the system mostly works, the ways we can pay for things are open to manipulation. Fraud and payment disputes are not only common, they are an expected cost of business. This is where cryptocurrencies come in. They offer a degree of traceability that eliminates payment disputes. They can also be more efficient than conventional banking. One way is by allowing people to directly transfer money to each other without having to incur the cost and delay of a third-party processor. A second is to make global transactions easier, because the currency would be worth the same amount everywhere. It wouldn't have to be converted using exchange rates. A third benefit is that we could hold on to our money instead of giving it to banks and having to ask for it back when we need it. Here's the basic concept. It's still based on a ledger, but instead of using private third-party ledgers, it uses a shared public ledger open to everyone. Personally identifying information is hidden, but transaction histories are open to public auditing. A public ledger means there's one source of truth for every transaction, and ownership rights are always clear-cut. This can eliminate payment disputes and many types of fraud, such as securities fraud, counterfeiting, money laundering, tax evasion, and so on. All of those rely on gaps and loopholes in our current maze of accounting systems. Furthermore, anyone can access or validate transactions in the public ledger, and transactions are only accepted after they've been validated by other users of the system. This is done using a revolutionary technology called the blockchain. I'm going to use the word blockchain going forward, but remember that it refers to the public ledger we just mentioned. The blockchain has rules that allow it to be self-policing, self-repairing, and efficient. It can get fairly technical, but let's cover the basics. First, let's refer to any attempt to defraud the system as bad data, because in order to work, that's what has to make it into the ledger. That includes attempts to double spend or spend money more than once, or to claim false ownership. The blockchain is specially designed to identify and reject bad data. The key is that the blockchain is not a database. A database stores data in a specific place, and that data is owned by someone. If it is hacked, everyone is affected. In contrast, what the blockchain does is distribute a copy of the ledger to all users. so that it's stored on millions of computers at the same time. In order for someone to add a change to the ledger, they have to broadcast the change to other users. The other users inspect and confirm the change against their own copies of the ledger. If it does not meet a network-wide consensus that it's a valid transaction, then it's quickly rejected as bad data. There is also powerful cryptography applied to the ledger. The block in blockchain refers to a group of transactions which happen around the same time, like a single page in a ledger book. For Bitcoin, a typical block would contain a few thousand transactions, and a new one is added about every 10 minutes. Every transaction in a block goes through a multiple point inspection to confirm that it's valid. The block is then sealed using a hash algorithm, also called a digital signature. A hash algorithm works by providing several data inputs from which a single unique code is generated, called a hash. If any of the data inputs vary even slightly, it results in a completely different hash. You can't go backwards. There's no way to look at the hash and determine what the data inputs were. Hashes can be used to detect if data has been altered. By taking a hash at the time data is created, it creates a unique signature that verifies that the data is authentic. If the data is modified even slightly, a rehash will not match the original, indicating that something's been tampered with. One of the clever things the blockchain does is to use a hash of the previous block as an input for the hash of the next block. This is what chains the blocks together, because if any block is tampered with, the entire ledger gets broken. That makes it impossible to tamper with historical data. But who is confirming the transactions and adding blocks to the blockchain, and why? The answer is a special type of Bitcoin user called a miner. Someone has to dedicate the computer equipment and bear the electricity costs it takes to confirm transactions. Miners bear these costs because they are rewarded in the form of bitcoins, just as gold miners are rewarded in the form of gold. This is how bitcoins are created. A certain amount of bitcoins are rewarded to a miner when they successfully add a new block to the blockchain. This incentivizes people to be miners and to process transactions, and puts bitcoins into circulation at a steady rate. Miners can also collect transaction fees offered by other users. In order for the system to work, mining needs to be costly, competitive, and fair. It must be costly because if it has no cost, spammers and hackers will clog up the network. The system makes it expensive to mine by adding a step to the process that requires a lot of processing power and electricity to get past. This makes it easy to lose money mining bitcoins if you don't know what you're doing, or not playing by the rules. The concept is called proof of work, and the way it works is to make sealing a block with a digital signature computationally expensive. Remember that a digital signature is a hash, and what the hash looks like is unpredictable. Bitcoin demands that all hashes need to follow a pattern, one that is very improbable, such as starting with a certain number of zeros. To try to meet this pattern, the miner is asked to supply a random number input, which alters the hash. It probably won't work the first time, but the miner can keep trying random numbers and rehashing until it fits the pattern. This means trying billions of possible numbers. That might take years for a single computer, but it only takes a few minutes in Bitcoin because many miners work on it simultaneously, using custom hardware designed for this purpose. To keep it fair, every Bitcoin transaction is broadcast to the entire community and enters a lottery where any miner can claim it. Each miner adds the transaction to a potential new block, but it is not accepted into the blockchain unless and until they solve the proof of work problem. When they do, the public ledger gets updated and the miner gets credit for the transactions. On the other side, regular users can transfer and receive bitcoins using a software program called a Bitcoin wallet, which you install on a computer or mobile device. There are also services that can convert regular currency into equivalent bitcoins, which can be a fraction as small as 100 millionth of a bitcoin. It should be noted that Bitcoin users must take security into their own hands. Bitcoins are just information, represented by codes that you have to keep safe. If someone gets access to these codes, they can spend your money. There are specific techniques and devices for securely storing cryptocurrency, and you should learn about them before you jump in. Keep in mind that this was just a high-level overview, and cryptocurrencies are likely to evolve over time. They are still a subject of frequent debate. One question, for example, is if cryptocurrencies represent true value. There are some who argue that money is not really worth anything unless it is backed by an equivalent amount of gold. The gold standard is closely linked to the Great Depression, when it became a problem because everyone rushed to convert their paper money to gold. However, the government was trying to encourage people to spend money on something other than gold to prevent an economic collapse. As a result, the gold standard was dropped so the government could expand the money supply to stimulate the economy. What we now have is fiat money, which is money that has declared value that is backed by the government and is the only legal tender with which to pay taxes. This is still considered strong backing, at least as long as the government is there. But what about cryptocurrency? Some argue that it lacks intrinsic value because it has no commodity equivalent, nor does it have the fiat backing of government. Others argue that it provides value via the benefits of its structure. In other words, it has greater capacity and flexibility for conducting transactions and more security and efficiency than other forms of money, and thus creates value as a means of commerce. With regular money, the government can print more anytime it wants, causing inflation and the value of a dollar to go down. Bitcoins, on the other hand, can only be created by mining them, and they are capped at a total of 21 million bitcoins. That means demand is the primary determinant of Bitcoin value, which many believe is the way it should be. Of course, there are still many things that can happen. Governments may pass legislation that affect how or if cryptocurrencies are accepted. The question of how to tax cryptocurrency transactions has yet to be faced and will require some new solution. We can also expect banks and intermediaries to take action on cryptocurrencies. Some will get in on the action with the related products and services, while others may try to steer people away from them. Finally, the Bitcoin community itself can make changes. As a democratic social community, Bitcoin users collectively vote on how the rules should work. Sometimes that means the community may be divided over a significant change. If they cannot reach consensus, it causes Bitcoin to fork or split into variants, with different sides supporting the variant they prefer. This could cause volatility in Bitcoin value or adoption. Remember, there are many other cryptocurrencies out there, such as Ethereum, Litecoin, Monero, and others. It still remains to be seen how they will fare in the coming years. Regardless of how it all pans out, most experts agree there is one element that will have far-reaching application. That is the blockchain, the system that makes cryptocurrency possible. In an era when hackers can break into any database, the blockchain presents a real solution for trusting data. It could enable new efficiencies in healthcare, insurance, charities, retail, even government. Imagine using a blockchain to verify if your produce is really organic, for example. Even more interesting is the prospect of secure online voting using the blockchain. At least the possibilities are there. In addition to startups, big companies such as Google, Goldman Sachs, Samsung, and IBM are all investing heavily in blockchain technology. While we can expect failures along the way, the successes may redefine how things work in the future. Together, let's keep an eye on these technologies and figure out how to make the best of them. Thanks for watching. Don't forget to subscribe if you enjoyed this episode, and I'll see you next time.